homeownership for half a century? Yes, the 50-year mortgage is officially being discussed. So let me break down what that actually means for you and why this is even coming up in conversation. I just spent the last week or so in rooms with lenders from all across the country and realtors and economists from both the lending industry as well as the National Association of Realtors. Literally, it was 2 days with the American Association of Private Lenders, and it was 5 days with the National Association of Realtors, and economists from both industries were there in the room. And trust me, this idea of the 50-year mortgage was not a fringe concept. It came up in both rooms multiple times with both audiences. So we got to talk about it. We got to separate out pitch versus reality. So on paper, the 50-year mortgage sounds like a great idea because it could literally lower your monthly mortgage payment anywhere from $200 to $300 or more a month, which who wouldn't love the lower monthly mortgage payment, right? But the drama is that if you're paying less each month on your mortgage, that means that you're paying less towards your principal and more towards your interest, which when you do the math, it could literally have you pay hundreds of thousands of dollars more over the life of the loan for the same house. Because what you're going to do, same house, because what you're going to do is you're going to build equity slower and you're going to pay way more for the same house. Think about it. It's kind of like when you can say, I'm going to pay for a car at a 3-year installment plan, or I'm going to pay for that same car in a 10-year installment plan. Well, if you're done in 3 years, you're free and clear in 3 years. If you have that same car and you drag it out for a 10-year payment period, then by the time you get to the 10-year mark, that car might be a beater and you're still making payments on it in years 7, 8, 9, and up to year 10. It just doesn't work out well for you. So, yes, you could be paying less for the product in a monthly basis, but you're going to be paying on it for a much longer time period, and your final cost is going to be much higher. Does that make sense? So why does this matter, especially in markets like Arizona? For fast moving markets like Phoenix, particularly, the pitfall is that if more buyers come off the sidelines because they qualify for a lower home payment, then that means increased competition for buyers, right? So back we go to the multiple offer situation, and back we go to sellers have more choices to choose from and which offer they accept. And when that's the case, then sellers find it super easy to start raising prices to get the highest amount for their home, which is understandable. But you as a buyer, that competition is going to be hard felt in your purchase price at the end of the day, which means the benefit that you might have gotten from having a lower payment might quickly disappear because you're having to pay more for the house. So the other side of that, think a little bit further down the road. If in 5 to 10 years you get ready to sell that house, which is the average time for most homeowners, then you may not even have enough equity built up at that time because you've only been making interest payments. You might not even have enough equity at that time to be able to sell that house and move up to your next house, which is typically what happens. But if there's no equity, there's no move up opportunity. If there's no move up opportunity, then what have you been doing for the last 5 to 10 years, right? You might not even have enough equity to sell. And it's a sad day when you have to actually put money to the table in order to sell your home because there's not enough equity in it to cover and give you something out at the end of the day. Not a pretty sight. So before you get all excited and jump at the idea of a cheaper mortgage payment, let's look at the full picture. Let's talk about your long-term costs, your equity timeline, and your financial goals. So, wanted to make sure we got really clear on the downside of a 50-year mortgage because it does not increase your ability to pass on generational wealth. It does not increase your ability to even accumulate wealth. If they want to talk about getting more home buyers in homes, the real conversation needs to be about building more affordable homes. not playing bait and switch on the loan product that tricks you into thinking that you're getting an opportunity when really you're getting set up for failure. Because the average first time home buyer right now is 42 years old. And can you imagine buying at 42 and still having a mortgage at the age of 90? If you intend to retire at age 60, 65, or even 70, then where are you going to come up with that money to make a mortgage payment from ages 70 to 92? It's just not even feasible. So it is a setup. It's bait and switch. Do not fall for it. The other side of it is, let's say, you know what? Hey, I'm smart. I can do the math. I can work it out, because money is math and mortgage is basically a calculation, right? Over time, they amortize it to figure out how much you would pay for the total life of the loan. So let's say you figure it out with the help of your handy dandy mortgage advisor and your realtor. We can do the math. We can say you can beat the system if you're disciplined enough to make the additional payments to chunk down your interest and start getting to that principal faster. There is a way to beat the system, but that is a small portion of the population who can do that. So if you're not that disciplined, or if your finances are too close to make that happen, then this is not for you. If you want a side-by-side comparison, if you want to see what your options are going both ways, send me a message or join my next homebuyer education class, and we'll walk through the options for you so that you can make a smart money decision.